Hi, everyone. Welcome to Ask Me Anything with Joe Daniels with Thai New York. My name is Devika, and I'm excited to welcome you to this live stream on where Joe Daniels will be talking about everything angel investors and early stage entrepreneurs need to know as they start to raise capital. To introduce Joe, it is Pankaj Jain, who leads our Thai New York Angels Committee and also a Thai New York board member. So welcome, Pankaj.
Thanks, Devika. Hey, welcome everyone. I'm Pankaj. I'm a board member at Thai New York, and this is our first in hopefully a long series of conversations with Joe on the legal aspects of getting started. And today we're going to talk about the pros and cons of safes and convertibles. Joe, welcome.
Hi, Pankaj. How are you?
Very good, thanks. Love to get a quick intro from you, Joe, and then we'll kick off the presentation that you have.
Oh, kick it into the slides. I've got stuff on myself and my firm right there.
Perfect. There you go.
Okay, so that's visible to our audience.
Yes, it is.
I'll take it from here. So everybody, welcome. I'm Joe Daniels. I'm with Nelson Mullins. This is my pros and cons of safes and convertible notes presentation. Also some stuff around that. I'm a partner and the co-chair of our emerging companies practice. Nelson Mullins is a 125-year-old full-service law firm. That means that we basically we have a department for everything businesses need, like intellectual property, litigation, real estate, tax. I'm in the corporate department, which is about 340 lawyers. We have 1,000 lawyers in 43 states and 30 offices across the USA, but we have a global practice because U.S. companies are engaged globally. And my group is a 75-plus lawyer group focused on representing startups and VCs and everything from, as I say here, formation, financing, growth, and exit. So that's helping you form the correct type of company, raise financing with notes and safes, and then preferred stock, the typical way that you do it in tech and life sciences, and then helping you grow through acquisitions and partnerships and commercial agreements of every type. And then exiting through an M&A deal or an IPO. And we're pretty highly ranked in the pitch book and Chambers and Partners, which is the league tables for law firms in the space. We represent thousands of startups and VC funds, some examples there. And for example, in 2021, we did about 190 deals for more than $8 billion. So we have a lot of people that know a lot about what the market terms are in the space. We also have a large IP group that has PhD level specialists in virtually every technical field, from biotech to semiconductors, and they basically handle the patent, trademark, and copyright prosecution, litigation, and licensing. Speaking of litigation, we also have hundreds of litigators ready to sue and defend all over the US. Hopefully it doesn't come to that. And I've been doing this for 26 years, including 8 in California during the dot-com days. I joined the group that took Netscape public and sold it to AOL right out of law school. And here are some of the big public companies I've represented: private equity and venture funds, investment banks. And I've done about 25 IPOs and follow-on public offerings, scores of M&A deals of every size and type, and thousands of financings. And I focus on high-growth sectors like tech and life sciences. So before I get into what the pros and cons of these instruments, notes, and safes are, I'm just going to talk about when you use them. Right, the typical way people use them is at the pre-seed round. This is where you have a team of 1 to a few strong founders, some product market fit, meaning at least a plan to technology if you haven't developed it yet, or a product that clearly addresses the intended large addressable market. Revenue is pre-revenue to usually $1 million in annual run rate. The round size is usually less than $1 million, but can be up to a few $1 million. And the caps are generally up to $20 million. And the investors are friends and family, accelerators, angels, early stage VCs sometimes, but usually not. And but then there's a lot of application of notes and safes in basically whenever you need to raise some quick funds and you don't want to set the valuation, or it's difficult to do that. In other words, in between preferred stock rounds, in between your series A and B, in between your series M and N. So this, you probably will use these concepts many times throughout your startup's life. So, and then why would people, so everybody knows that well, not everybody. If you don't know, then all of the major tech companies in the U.S. at least have been raising their money through selling preferred stock, Series A, B, C, up to Series N for SpaceX now. And we can have another discussion about that, another whole session about that. But why would you use the notes in the safes instead of the preferred stock? And here are the basic reasons. Number one, you don't have to set the company valuation. You may think the company's worth 10 million pre-money, and your investors think it's worth 3 million pre-money. So how do you come together on that? How do you? It makes it that gap makes it difficult to come together. You can't just split the baby and say, well, what about 7 million? Is that okay? And then they'll say, no, it's not okay. I think it's going to be 3. So instead, you use these instruments. I'm going to tell you why when we get into the terms. It's also a lot cheaper. I can have an associate bang out a convertible note or a safe for a few $100, and then you can fill in names and the numbers, and if people accept it, and they often do, then you've raised money. And that legal fees are between $500 to $5K. It depends on how much negotiation there is, as opposed to 10. I would say 5 at least to 10 to 150,000 for a preferred stock financing, depending on how much diligence is being conducted on the investor side. Also, after you sell these instruments, you can still issue restricted stock because the valuation of your company is so uncertain. And that restricted stock is better than a stock option from a tax perspective for all the recipients. Therefore, your personnel should be happy to get that, and arguably should be taking less of the salary or be okay with not getting paid. Also, and you don't have to do extensive cap table diligence if you're on the investor side. So that saves the company time and expense of helping the investors do that. People will often just skip cap table diligence altogether because the formulas in these instruments basically address the issue of the more shares that are issued, the more shares they're going to want to have to adjust for that. That's already taken care of by the note formulas. So we're going to talk about the terms of notes first because they're more complicated. Well, there's just more terms to a note than there is to a safe, and it makes it a lot easier to understand the safe when you understand the problems with notes for the founder. Okay, so the typical terms of a convertible note. Number one, it has a principal amount. That's how much is invested. That's going to be one variable in determining what the eventual ownership is. The interest rate's usually 2 to 6%. It's not heavily negotiated because it's not a big component of the investor's return or how many shares that the company is issuing on conversion, but it does add up the longer it lasts. But note the term is usually 18 to 24 months on these things, so it's usually not out there that long unless things don't go as planned and you don't get to raise your equity financing within that period, and then they can hang out there for years, and then the interest can really add up. So I mentioned conversion. So the one common characteristic about all convertible notes is that they automatically convert when you raise a minimum amount of equity financing. Let's say $1 million or $2 million. Like you're raising $750K of notes, and the note will provide that when you raise $1 million in equity or $1.5 million in equity, it's usually a higher number than the amount that you raise in the notes, will automatically convert the notes. That way the note holder cannot hold out for more when that minimum target is reached. So what's the conversion price when that happens? So usually they get some kind of a discount. This is the classic convertible note going back to the 80s. It's most favorable to the founder, 10 to 25% discount to the round price. Why? Because let's say that you have the hypothetical I just mentioned. You think the company's worth 10, the investor thinks it's worth 3. Then you go out and you raise, you give the note holders a 10% discount. You go out and raise at 20 in your next equity round, and their discount is only 10% off of 20, or basically 18. So they're getting in much higher than the 10 that you originally suggested. However, note holders began to figure that out, so they began to put caps in there. Now 85% of notes in safes have a cap. And what that is, the cap is not today's valuation. It's supposed to be a number between today's valuation and the eventual raise. So for example, in the situation where the hypo of you think it's worth 10, the investor thinks it's worth 3 million, then what about a cap of 7 million? That's not splitting the baby, like I said, when you're trying to set the valuation in equity round. So if you end up raising at 6 million and there's just a cap only, then the note holder still converts at the 7 cap. right? Or sorry, the opposite of that. The note holder gets that $6 million price, but if you raise it $20 million, they get in at $7 million, right? So, but it's supposed to be set higher than today's valuation. Keep that in mind. And of course, the least favorable is where the note holder asks for the lower of the discount or the cap. So in the example of if you had a 10% discount where you raise at 6 and the cap is at 7, but there's a 10%, then they get another 10% off the 6. So they sort of have it both ways. And so, most people who analyze this think from, financial point of view, this is, most to least favorable for the founder. Keep in mind that the conversion formula is fully diluted. So if you adopt an option plan before the equity round, then it's going to include those equity plan shares. That's why a lot of people will adopt the plan after the financing or in connection with it. Importantly, the distinction between pre-money and post-money note or safe. If the conversion formula includes the shares that issuable upon conversion of other notes and safes, that can obviously significantly dilute the founders of the common stock. For example, let's say you raise $1 million in your convertible note round, and that's at that 7 million cap that I mentioned. And then you raise another million at a 10 million cap, note or safe, it doesn't matter. And that means that when the first 7 million caps, a million in notes, converts into an equity round, all the shares in the second million are included for determining its conversion price. Conversion price is basically the cap amount divided by the fully diluted. The more shares in the denominator, the lower the conversion price. Therefore, the higher the number of shares that the investor gets. So that comes right out of the common stock. Next big thing of a convertible note is what happens on a change of control. The standard in the Valley and all the New York tech centers around the country is that it gives the investor on a change of control, the investor will get 1 to 2 times what they invested plus the accrued interest, or they have the option to get that, get their payback amount, or they convert at the cap price, or if it's a discount only note, or then at a discount rate to the price that is paid to common stock in the acquisition. So if it's common stock's getting $1 in the acquisition, then the note's converted 80 cents, so they get a little bit of a return there. So that basically means they're going to at least get their money back if they have this option to get the 1.1 to 2x. So some alternative structures there that are more favorable to the founder would be to take out the 1 to 2, or at least limit it to 1x as opposed to 2x, right? Because when you're selling the company for a smaller amount of money, that basically means that they're either going to get 2 times what they invested or 1 time off the top before you get anything. And then it still converts automatically or the alternatives are instead of having the option of 1 to 2x, and instead it just converts automatically at the cap. Or a hypo 7 million. Therefore, if you sell at 5 million, then they're actually they're paying a higher price for the common stock than is being received by the common stock in the acquisition. Or you can have the notes convert at a discount to the value of the consideration paid to common in the acquisition. We're getting complicated. It's M&A. The bottom line is you got to pay attention to these formulas. Then, importantly, what happens at maturity? So what happens is that the note comes due, and then that gives the investor a claim for repayment of the principal that they invested plus all their accrued interest. And then it continues to accrue until it's paid. And sometimes there's a penalty interest, which adds up on top of the regular interest. So this is not a fun time for the founder, because if they haven't had that equity round, then they probably don't have the money to repay it. But at the same time, it's not a great position for the investor to be in, because they're trying to collect money from a company that doesn't have any money. So usually what happens is that people will extend the convertible notes, or they will take you to court or send a demand letter. And sometimes you can buy them out at a discount. Sometimes you have to pay back the entire amount. You can either negotiate a lesser amount or pay them back, or you do nothing and they get a judgment and they try to harass you through the legal process. And convertible notes are usually not secured, especially in pre-seed situations. But if you happen to agree to that, which is you should not do, then this would give the holder the right to sell the company assets, actually take possession of your assets and sell them to repay the full amount of the note plus interest. So some alternatives to that are to make the note automatically convert at the cap, like at that 7 million cap I explained, which would make it more like a safe, because that's what happens. Well, a safe has no maturity date, so as we'll get into, so that removes the pressure of what happens at maturity that we just discussed. Or you could have it automatically convert at a valuation agreed upon at the time by the company and a majority. So a majority of the principal amount. But the problem is the majority of principal amount of notes may not agree with the valuation that you want to convert it at, and then nothing happens. And then last, this is in the order again of best to worst for founder. Make it optional for the investor to convert at the cap or to be negotiated valuation. But then the note holder can still demand repayment, so you still have the potential risk of that hammer of like, give me my money back. Okay, so with all that understanding of convertible notes, now let's explain the major distinctions with a simple agreement for future equity, which, by the way, is the most popular and common means of pre-seed financing, and all sorts of probably a good chunk of the entire angel and VC investment economy these days. It's totally taken over the Bay Area and lots of the other tech centers, which usually take a little bit longer to catch up to the concepts. What's the difference? It's exactly the same as what I just described as a note, except in terms of what the standard terms are. But it does not have a maturity date, so the holder cannot demand their money back if there has not been an equity round, and it does not accrue interest. So you don't have to worry about that adding up, and it's never secured. So it eliminates a lot of the issues with a convertible note. And since the people that and you think, why would investors go along with this? Why is it so popular? And the bottom line is that if you're someone who has over 10 million in net worth that's investing in a bunch of startups, and which is your typical angel investor in America, and you I know obviously there's plenty of them that are less than 10 million. No offense if you're not there yet. If you're let's say one of 10 people who are investing $100,000 in $1 million note or safe round, and you go with convertible notes rather, and after 12 months or 18 months, 2 or 3 of those investors are demanding their money back, it can totally blow up the operating plans or the ability of the company to raise money, because they have to deal with the demand letters and litigation, which no new investor likes to hear about. And if a new investor comes in and invests another $1 million or $2 million, they don't want some of those funds being used to pay back the convertible note holders who are demanding their money back. So in other words, it's dealing with the issue of weak hands in the cap table, weak investor hands in the cap table who are not really speculating until the end of the company's life. The typical the investor that's not going to be asking for their money back, they're looking for the entire upside in that investment, or to write it off. They're not really looking for. They don't really care much about what comes in between. Of course, it's nice to get your money back if it's not such a great situation. So that's why safes are popular. Keep in mind, you want to use the pre-money safe if you can on the company side or the founder side, instead of the current Y Combinator post-money safe online, for the exact same problem that I mentioned before, which is that all subsequent notes and safes get included in the conversion price formula for the post-money safe. The only problem with safes is that some investors just don't get it. There's all these little pockets of angel groups and all over the country where they actually think it's an important component of angel investing to be able to demand your money back, even though like as we used to say in the Valley, try to get water from the stone, or get money from something that doesn't have any money, right? I disagree with that. I think most angel investors disagree with that, and sometimes those people just need to be educated. Just one final note before we open it up to Q&A. So if note and safe investors are investing a lot of money in the round, then they often will request different little modifications or side letters. And it's good for the company to put any modifications that are agreed to in a side letter rather than in the form of note or safe. And people, by the way, people do note and safe offerings at the same time. Like the main offering is safes, but if someone demands a note, then you give them a note. just to provide the founders the maximum flexibility. And that may or may not be advisable, but that often happens. So these modifications will generally include most favored nation rights. Actually, this was included in the Y Combinator form of SAFE. And that basically means that if let's say you offer a convertible note or a SAFE at a 7 million cap again, and then you sell 200K of that, and then someone comes along and says, well, I'll put in $1 million, but I want a 6.5 million cap or a 6 million cap, which is better for them, of course. So in that situation, the old investors, of course, want a reduction in cap too, and that's why they ask for most favored nation. And the argument you typically make on the company side against this is that why should these little, 50K, 75K, whoever adds up to 200K investors get the same more favorable term that the $1 million or $2 million investor receives? And the company needs the flexibility to have some, minor deviations in terms in order to raise the maximum amount of money, so that not the maximum amount, but the amount of money it needs to get to the next level, right? So we usually reject that on the company side, and people usually go, give it up. Probably the second most, or the first most requested additional right would be pro rata rights. It's very important to investors to be able to purchase the same percentage of the next equity round as they bought in the note or SAFE round that they invested in. This is not so bad if it terminates at the closing of the very next round, which is market. But some of these pro rata rights language, letters, and provisions last forever, and that can be a problem because, number one, pro rata rights usually dilute the founder. If you have a lot of leverage, you can avoid that. But because most investors who are structuring venture rounds these days will set a post money valuation. So if you're raising like let's say 5 on 20, and that's a 25 million post, right? So if you then have 1 million pro rata rights holders wanting to invest in another $1 million, that makes your effective pre-money valuation, which determines the percentage of the company owned by that set of investors, down to 19, right? And so try to limit the pro rata rights who you give them to people who invest more money. Number one, don't give it to everybody, because it's not hard to manage administratively, but it can dilute you. And the new investors do not exactly necessarily want everybody and their mother to participate in every single round as well. They may want those investors to be diluted. Then board or observer seats. So we usually never give up board seats in connection with a pre-seed note or SAFE round. I suppose if it's a giant note or SAFE round in between preferred stock financings, perhaps in a distressed situation, you might do that. But it is common to give observer seats. But based on my recent experience with the client who was pretty prolific in giving up observer seats, you don't want 10 people chiming in at your board meeting, right? So you want to limit who you give the observer rights to as much as you can. Usually that's based on how much money that is being invested. And then finally, some very aggressive, or perhaps you'd say, investors don't understand the markets, or this particular market, will ask for a bunch of blocking rights. I want a blocking right on your raising money in the next equity round, or the terms of that, or selling the company, or making a dividend, or purchasing stock, or whatever that, or paying a bigger salary to the CEO. And these are usually never given in a note or a SAFE financing, and so you should basically try to avoid those restrictions. And just because that's market. So I think that's all I've got on slides, and let's move to Q&A. Ask me anything.
Joe, that was brilliant. I think you covered a lot of ground very, very quickly, and you hit a lot of the points that a lot of founders really don't know the nuances of, right? So I think that was really helpful for founders and investors alike. I want to just kick it off with a question that I have. I've seen in a lot of cases, founders go out and raise money on convertibles, and this is safes or convertibles either. Really thinking about dilution in terms of the cap, right? And really not understanding the nuances of conversion prices and converting at the cap versus converting at a discount, et cetera, et cetera. And for a lot of those folks, when they raised their first equity round, their Series A, and everything was converting, their waterfall calculations kind of blew out their dilution perception that they had, right? And they were over diluted relative to what they thought they would be.
Yeah.
What are some pieces of advice that you could give to founders early on about how to think about dilution in terms of their convertibles or their safes that they're raising? What should their legal team be doing in terms of showing them, hey, worst case and best case scenarios for dilution when the conversions do happen?
Right. So, I mean, if you're one of the I'd say top 20 law firms with a big team in the space in America, then you're pretty good at creating pro forma cap tables. And what that means is assuming let's say you have some common, you have some convertible notes and safes outstanding, assuming the equity round is like 10 million pre-money or 20 million pre-money, what do the notes and safes all convert into, so that you can see how that plays out in terms of dilution before you even sell the notes and safes, right? So you're assuming how much you're going to sell in notes and safes, and then how much the equity round after is going to be, because the pricing of the notes and safes is all based on the valuation in that round. And it's pretty complicated math. I think you have to be, really pretty good at math to be able to do this in your head. So in other words, the best way to understand it is to become fully informed. And yeah, your law firm should be able to give you that. We do that all the time.
Are there any particular tools that you might suggest founders try out online that could help them kind of get at least a ballpark figure? Because sometimes this could be billable hours they may not be able to pay for, right? So are there tools that they could use before they go to their law firms?
Yeah, I mean, probably the one that I see most commonly used now is Carta. So Carta, Carta is basically both a transfer agent. It allows you to track your whole cap table online, which is great because there's a lot of wasted time or time spent on figuring out, all the paperwork and everything and what the capitalization is. I think it's a great time. And then it also allows you to create reports and then assume finances, and it actually produces pro forma cap tables. So I'm not saying that it's always right or perfect, but it's certainly a good start. And then you could, run it by your lawyers, and that's a lot less time.
Fantastic. All right. So we got a question from Bijal. Can you give some insights as to the litigation that results from disgruntled investors?
I'm just thinking back on all of the note and safe investors that I've dealt with on the, as the counsel to the company. And I don't think any of them, maybe only in one instance in 26 years, have the investors sued. And that was where those investors were really brought into the deal. They were number one, not accustomed to startup company investing, more like a real estate investor or something like that, or a mom and pop business investor. And they did not become fully informed when they made the investment. And then that's why we ended up in that situation. But what can happen is exactly what I explained. If with an unsecured convertible promissory note, then you can sue for repayment. That's what a note is. It's an IOU. I owe you money as of blank date. So, and once you've signed that document, it becomes easier to get a judgment against you in court. That's the whole point of it. If it's secured, then and I remember back in the .com crash, we do secured note financings, and there might have been some filings relating to, we want to get control of the assets so we can sell them and, pay back our debt. But on the whole, these things are usually negotiated because it's more costly to the investors to spend the money on lawyers to get their money back than it is to just demand it.
Makes sense. Yeah, I think that brings up another interesting point about making sure when you're raising money that you are raising from folks that are unlikely to sue, right? Like if you are a professional angel investor and you've done 10 deals before, you're less likely to sue than, somebody who owns a small business who's like, invest in my friend's uncle's startup, right? So
yeah, absolutely. Yeah.
Not all money's the same.
Yeah, when I was talking about the example of the wrong type of investor to get in your cap table, and that's the one that ended up suing my client, or at least filing. Didn't really prosecute that suit.
Yeah. All right, we got another question from Harjeet. I see so many deals where safe notes are being used. Oops, sorry about that. After the Series A, rather than a bridge round or a convertible note, is this the new norm if the company didn't meet its targets and just raising capital on a safe note?
Yeah, it is. It is becoming the new norm. As I explained, I believe that safes are in most markets more popular than convertible notes for the very problems that I mentioned, which is that people don't want weak hands having too much control over the company. Weak investor hands, that is.
Yeah. I got another question for Joe about MFNs, and YC has kind of made MFNs very common. They get MFN status in all their safe notes. What's the practical implication of MFNs for most founders that might be just taking the YC safe and using it for their deal without really understanding what's involved? It's a standard and everyone does it, but some of the founders may not really understand some of the implications that 6 months or a year down the line they may get hit with. So could you talk a little bit more about that?
Sure. I mean, in the past 5 years, for example, it's been pretty much an up market in terms of valuations, and maybe perhaps you could say easier to raise money. So, in other words, if the terms of all your security offerings, note, safe, or preferred stock keep going up, then it doesn't really matter because the MFN never comes into play. But if, for example, you have to do a quote unquote down round, like that situation where I explained, you've raised $250K at a 7 million cap, and then you raise, 2 million at a 6 million cap, that's going to automatically reprice the 250K to 6 million. And of course, if you just increase the numbers in the first offering, and so if it's like you raise $1 million and then 500K at the lower price, then that adjusts that whole $1 million down. So it can be pretty significant.
Cool. Joe, I want to be mindful of your time. I know we're approaching the end of the time that we had allocated with you. Thank you so much for doing this. I think this was brilliant, and hopefully we'll do another one in about 3 or 4 weeks, and we'll dive into some more details on the legal side of getting set up at a startup. And maybe we'll touch on some points that investors need to know about as well.
Yeah, that sounds great. We'll do it.
All right. Joe, thanks again. Appreciate your time. I'm going to close out the stream in a couple of minutes. So if anyone has any questions, throw them in right now. Otherwise, we're going to end the stream in about a minute. I just had one quick question for you. In terms of investors, are you seeing a preference between safes or convertibles, specifically in New York and the East Coast? I know on the West Coast, most investors just go with the safe no matter what. But on the East Coast, are you seeing a difference in what investors prefer?
Yeah, absolutely. Right. So for quite some time, I think it's still the case. The New York Angels, which was once, probably maybe still is, one of the more prolific angel groups in New York, would not invest in any converts, neither convertible notes or safes. Basically, because their contention was that they would get diluted or overly diluted. I think that's a symptom of early stage investing altogether. It doesn't really have to do with the instrument, but Brian Cohen would debate me ad nauseum about that, I'm sure. So there's that. You can't even sell notes and safes to those guys, right? Or at least the group as a whole. In New York, people tend to think that it's just better to get more terms that are favorable to the investor whenever they can. It's just that mentality. Whereas people in the West Coast tend to be more, I think, more accepting of founder favorable terms. So some of those terms in the note in the note context are having a maturity date, having an interest rate, and sometimes even having a secured interest, a secured note. So just to be able to have as many levers on the company as possible to ensure that they get their money back or the maximum return. But I still think that people, the SAFE is catching on day by day, and I can't give you a percentage on but I think I see more SAFEs than notes now, even in New York.
Yeah, I think just from a competition perspective, I think a lot of New York investors that might have avoided notes and safes before have no choice but to go with them today, just because of the competition in these deals.
Yeah, that's right. It's a hot market still.
Yeah. All right. Well, Joe, thanks again very much for all your time. Appreciate it. And thank you, everyone, for joining us today. We will do this again in about a month.
All right. See you later, guys.
Take care.
Thank you.
Thank you.